They wanted you to panic. They needed you to sell. And for 48 hours, it looked like they won. Silver dropped 8% in a single session. Your portfolio bled. Your hands shook. The headlines screamed crash. But here's what they didn't tell you. While you were watching your account implode, the biggest players in the world were doing something else entirely. They were buying, not selling. Buying. And now just 3 days later, silver is back above $73. The trap didn't work, but most traders still don't understand what just happened. They think this was a normal pullback. They think the danger has passed. They're wrong. This wasn't a pullback. This was a coordinated attack designed to steal your position before the real move begins. The banks threw everything they had at this market. They dumped futures contracts at midnight. They triggered stop losses in waves. They painted the charts to look like the end of the world. And it almost worked. Almost. But something broke their plan. Something they didn't expect. The physical market refused to follow the paper price down. While silver futures crashed to $70, the actual metal disappeared from the shelves. Dealers ran out of inventory. Premiums exploded. China kept buying. The disconnect between what the chart showed and what the real world demanded exposed the entire manipulation. And now we're sitting at a turning point that most people will miss. The question isn't whether silver will recover. It already has. The question is whether you'll still be holding when it reaches 100. Because everything that just happened, the panic, the crash, the recovery, it was all theater, a dress rehearsal for the real show. And the real show starts Monday morning when the institutional money returns from vacation. Right now, we're in the eye of the storm. The market is calm. Silver is consolidating between $70 and $75. The weekly chart looks stable. The media has moved on to the next crisis. This is exactly where they want you to relax, to think the volatility is over, to believe you can predict the next move and trade around it. But you can't. Because what's coming isn't technical, it's structural. The global silver deficit didn't disappear when the price dropped 3%. The supply crisis didn't resolve itself because some hedge fund dumped contracts at 2 in the morning. The fundamentals are screaming one direction while the price action whispers another. And that gap, that massive disconnect between reality and perception, is where fortunes are made. Let me show you what the charts aren't telling you. Gold just hit $4,360. It's up nearly 1% today while everyone obsesses over silver. Why does this matter? Because gold is the general. Silver is the soldier. When gold holds its ground during a silver crash, it's sending a message. The message is simple. The macro thesis is intact. The big money, the central banks, the sovereign wealth funds, they're not selling. They're buying the dip. And if the smart money is accumulating gold at all-time highs, then the silver crash was exactly what it looked like. A manipulation, a fake-out designed to separate the weak hands from the strong. Silver didn't crash because the bull market ended. Silver crashed because it's more volatile. It overreacts. When gold sneezes, silver catches the flu. But when gold recovers, silver runs a marathon. Right now, gold is healthy. It's consolidating near record highs. It's acting as a magnet for silver. And the gold to silver ratio is sitting at 59. In a normal bull market, that ratio compresses to 30. For that to happen, silver has to run twice as fast as gold. The math is simple. If gold stays stable at 4,300, silver needs to hit $143 just to reach the historical average. We're currently at 73. That's a 96% move sitting right in front of you. And most traders will miss it because they're focused on the daily noise. They're watching the 1-minute chart, wondering if 72 is support or resistance. Meanwhile, the whales are looking at the decade chart and loading the boat. This is the difference between retail thinking and institutional thinking. Retail asks what happens tomorrow. Institutions ask what happens when Samsung runs out of silver paste, when Tesla can't source enough metal for solar panels, when the U.S. military triggers the Defense Production Act because missile production is constrained by supply shortages. Those aren't hypothetical scenarios. They're mathematical certainties. The world uses more silver every year than it mines. That deficit compounds. And compounding deficits don't resolve peacefully. They resolve explosively. But here's what makes this week so critical. We're heading into the first full trading week of January. This matters because last week was a ghost town. Senior portfolio managers were skiing, trading desks were half-staffed. The volume we saw was just the advance guard. On Monday, the main army arrives. Pension funds finalize their first quarter allocations. Algorithmic buying programs switch on full blast. Investment committees meet to deploy the $50 billion sitting in cash waiting for the new year. This institutional volume is different from retail volume. When a pension fund buys silver, they're not day trading. They're building a position for the next decade. They don't sell when the price drops $2. They add to the position. This removes supply from the market permanently. It shrinks the available float. And when the float shrinks in a market with rising demand, prices don't go up linearly. They go parabolic. We saw a preview of this dynamic on Wednesday. The crash wasn't driven by selling volume. It was driven by a liquidity vacuum. A handful of large sell orders hit a thin market and the price gapped down violently. But notice what happened next. The price recovered just as fast. Because the real buyers, the patient capital, they were waiting for exactly that moment. They had limit orders stacked at $70. When the manipulation triggered those orders, the selling dried up instantly. The price snapped back like a rubber band. And now we're sitting right back where we started, except the weak hands are gone. The traders who panicked sold at 70 are out of the game. The inventory they dumped got absorbed by stronger hands. This is how markets transfer wealth, from the fearful to the patient, from the reactive to the strategic. And this transfer just accelerated dramatically. But there's another layer most people are missing. The weekend. Right now it's Friday afternoon. The closing bell is about to ring. The market will shut down for 48 hours. And in those 48 hours, the world keeps turning. Geopolitics doesn't sleep. Currency crises don't wait for Monday. War doesn't pause for market hours. This creates gap risk. If a major headline breaks Saturday morning, when the market reopens Sunday night, the price won't be $73. It could gap to 78. It could gap to 68. It will instantly adjust to the new reality without giving anyone a chance to react. Smart money understands this risk. They understand that going into the weekend holding cash is a bet on peace. Going into the weekend holding silver is a bet on chaos. And if you look at the geopolitical chessboard right now, chaos is the safer bet. Tensions are escalating in the Middle East. Shipping routes through the Red Sea remain under threat. Supply chains are fragile. The South China Sea is a powder keg. And silver isn't just a monetary metal. It's a strategic metal. It's used in missiles. It's used in satellites. It's used in military radar systems. If a conflict escalates over the weekend, military demand for silver becomes priority one. Civilian supply gets redirected. Industrial users panic. And the paper price becomes irrelevant because the physical metal simply isn't available at any price. This is why the Shanghai Gold Exchange matters. While Western traders were panic selling paper contracts, China was taking physical delivery. Record withdrawals. They're not trading. They're taking possession, removing metal from the system permanently. This physical drain creates a time limit on the manipulation. The banks can only suppress the paper price as long as they have physical metal to back up their promises. Once the vaults run dry, the paper game ends. The price has to reflect reality, and reality is screaming shortage. We're getting closer to that breaking point with every dip. Every time the price drops, China buys more. Every time China buys more, the vaults drain faster. The trap the banks set for retail traders is actually a trap for themselves. They're selling their lifeboats to buy deck chairs on the Titanic. Now, let me show you what to watch next week. The volume profile. This is critical. When institutional money floods back on Monday, we need to see volume spike with rising prices. If we see high volume pushing silver above $75, it confirms everything. It confirms the January effect is real. It confirms the crash was just a discounted entry point for smart money. It confirms the bull market is accelerating, not ending. But if we see high volume with falling prices, that's a different signal. That means distribution. That means the big players are using liquidity to exit their positions. Right now, all evidence points to accumulation, not distribution. The price action, the physical demand, the gold strength, the geopolitical backdrop, everything is aligned. But markets don't care about logic. They care about liquidity. And next week, liquidity returns in force. There's also something you need to watch in the final minutes of trading today. The banks might try one last manipulation before the weekend. They might dump contracts into the close to paint the weekly candle week. They want the chart to show a shooting star or a doji to discourage technical traders. If you see a sudden drop in the last 15 minutes, don't panic. It's window dressing. It's artificial. They're creating a false signal so they can buy cheaper when volume returns Monday. Smart traders ignore the noise. They focus on the body of the candle, not the wick. And the body of the candle is trading well above $70. That's strength. That's resilience. That's a market that refuses to break despite coordinated attacks. But here's where psychology becomes your biggest enemy. You've survived the most volatile week of the year. Your position is intact. The price has recovered. You should feel confident. Instead, you probably feel exhausted, traumatized, gun-shy. This is exactly what they want. They want you mentally broken so that when the real rally starts, you sell too early. You take profits at 78 when the target is 120. You exit at 85 when it's heading to 150. The biggest risk you face in 2026 isn't another crash. It's premature evacuation, selling too soon, giving your seat to a pension fund right before the mania phase begins. And make no mistake, we are entering the mania phase. This is the third stage of a bull market. The stage where prices go parabolic. The stage where your skeptical friends start calling you for advice. The stage where mainstream media can't ignore it anymore. We're not there yet, but we're close. The institutions are just waking up. The public is still asleep. You have front row seats to the greatest wealth transfer in modern history. And the ticket you're holding, that silver position that almost gave you a heart attack this week, that ticket is about to appreciate dramatically, but only if you hold it. So let me give you the exit strategy, the targets that will keep you in the trade until the real money is made. Target 1, $85. This is the technical breakout level. Once we clear the all-time high resistance and push through 80, the chart opens up. 85 confirms the new paradigm. At this level, you do nothing. You hold. You let momentum build. Target 2, $100. This is the media event. When silver hits triple digits, the world goes crazy. Your coworkers will ask you about it. CNBC will run special segments. The frenzy begins. At 100, you might consider taking your initial investment off the table if you need the cash flow. But the smart play is to wait for the ratio, the gold to silver ratio. Right now it's sitting at 59. Historically, in the mania phase of a precious metals bull market, that ratio compresses to 30 or even 15. This is your real exit signal. Don't sell silver for dollars, sell silver for gold. When the ratio hits 30 to 1, swap some silver for gold. When it hits 15 to 1, swap it all. This strategy forces you to stay in the trade until silver is historically overvalued relative to gold. It protects you from selling early. It keeps you positioned for the full parabolic move. Right now, at 60 to 1, silver is still historically cheap. We have a long runway ahead, but you need psychological armor to survive that runway. You need to think like a whale. Billionaires don't stare at one-minute charts. They don't panic over daily swings. They use time arbitrage. They buy from impatient people today to sell to desperate people tomorrow. The retail trader plays a game of minutes. The whale plays a game of years. And the whale knows something critical. It takes 10 years to build a silver mine. The supply deficit can't be fixed quickly. So when the shortage becomes acute, when Samsung can't get paste, when Tesla can't source panels, when the military needs metal for missiles, the price won't rise gradually. It will explode. The whale is buying today knowing that inevitability is coming. You need to adopt this mindset. Stop asking what silver does tomorrow. Start asking where silver will be when the US debt hits $40 trillion, when the dollar loses reserve currency status, when central banks panic and print their way out of a debt spiral. Lengthen your time horizon and the volatility disappears. The crash becomes a blip. The rally becomes a trend. So here's the final verdict on this whipsaw week. It was a trap. It was designed to steal your shares. It failed. The market recovered. The price is back above 73. The weekly candle looks strong. The monthly candle looks historic. The banks threw their best punch and the market is still standing. This tells you the underlying demand is stronger than the manipulation. The physical hand is stronger than the paper hand. As you head into the weekend, relax. You're positioned correctly. You own the assets that's running out. You own the money of the future. Monday will bring volume. The real money returns. The trap has been set, but not for you. For them. The spring is loaded. The explosion is coming. And when it does, make sure you're still holding. Because the next move won't give you a second chance to get back in. This is where fortunes are forged. Stay strong. Stay patient. And whatever you do, don't let them shake you out now. The payoff is just beginning.